What is the ideal debt-to-income ratio for a VA loan? Have you ever wondered what the ideal debt-to-income ratio is for a VA loan? Understanding this can be key to your home buying journey. The ideal debt-to-income ratio for a VA loan is generally considered to be 41% or lower. This means that your total monthly debt payments, including your new mortgage, should not exceed 41% of your gross monthly income. This 41% guideline is used by the Department of Veterans Affairs to help lenders assess a borrower's ability to repay the loan. However, it is important to note that the VA does not impose a strict maximum debt-to-income limit. Instead, it provides this 41% figure as a benchmark for lenders. If your debt-to-income ratio exceeds 41%, lenders will typically perform a more detailed review of your financial situation rather than automatically denying your loan application. In cases where your debt-to-income ratio is above 41%, approval may still be possible if you can demonstrate strong compensating factors. These factors can include having high residual income, which is the amount of money left over after all monthly debts and living expenses are paid, a strong credit history, significant savings or assets, stable employment and income, or a lower loan amount can also help your case. Lenders may requiring you to meet at least 120% of the VA residual income guidelines when your debt-to-income ratio is above 41%. Residual income is a key requirement in VA underwriting that ensures you have enough income left over to cover everyday living expenses after paying your debts. From the perspective of banks and credit unions, the debt-to-income ratio is a critical tool for evaluating the risk of lending. While the VA loan program is more flexible than conventional loans, which often prefer a debt-to-income ratio of 36% or less, lenders still use the 41% guideline as a standard threshold. If your debt-to-income ratio exceeds this, lenders will look for compensating factors to mitigate risk before approving your loan. To calculate your debt-to-income ratio, divide your total monthly debt payments by your gross monthly income. Keeping your debt-to-income ratio at or below 41% improves your chances of loan approval and can lead to more favorable loan terms.